So we are talking about the Federal Reserve System and monetary policy tools in specific. And on Monday, we talked about the open market operations, discount window and discount rate, the reserve requirements, which are now zero, and interest on reserve balances, and so on and so forth. So we said that we actually make comparisons to other central banks and other, especially the ECB, European Central Bank. We're going to reserve that discussion to Friday, but today I want to continue and finish the policy tools. But while we're discussing these tools, I also like to, emphasize which ones are a lot more common and which ones are rather unique to Fed and unique to our more recent decade. The open market operations have been around for a long time, and that is one of the mainframes of one of the fundamental steps of money creation process, money supply process, economic expansion and contraction through Fed buying the treasury securities from banks, and then therefore providing them with reserves, and that provides loans, and we discussed. So then we talked about the discount window and the discount rate, and one of the I think um, ideas behind this is that the central banks are always lender of last resort, and this is pretty universal, and this has been around for a very very long time. And I guess one of the things that perhaps we could talk about this, which is not really a monetary policy tool, but we talked about this, in the past. So I think it's now time to differentiate the discount window, the discount rate, and then the Fed funds rate. With the discount window and the discount rate, you basically are looking for the member banks borrowing from their Federal Reserve banks in their region, and the discount rate is set by the Fed, and it literally is the lender of last resort. So in any given day, the banks can have money coming in, money leaving, and then they might actually have reserve needs or some liquidity needs, but for very short periods of time, usually overnight. And for that, they may, try to get lending facility from other commercial banks, deposit institutions, and if they run out of options, obviously the Fed is there to help through the discount window. Then we also have the Fed funds rate, um, which we discussed, which is not a monetary policy tool, but just for terminology purposes, Fed funds rate is the rate which the deposit institutions actually lend and borrow from each other through their reserve accounts. And the rate is actually set by the Fed as well, but it also facilitates a very similar own overnight needs of the deposit institutions. However, it is not a specific policy tool. So with the discount window and the Fed funds rate, you need to know the difference between the two and their intent. They both serve very similar purpose. From a bank perspective, you actually have a need or a surplus overnight or for just a few days, and you try to borrow within the open market operations, and meaning yourself, you try to go to the other banks and in the market operations, and you try to borrow. And you run up options, you can go to the discount window. Now, if your overnight need is for reserve purposes only, that your deposits went up for that day, and therefore you need to increase the reserve. You don't have the money, you're actually a bit short, so you need that short-term funding for the reserve purposes only. Or just the opposite, your deposits went down for that day, you have a surplus of reserves, but that's not going to be for a long-term change, and therefore you actually have a little bit of a surplus, and you're trying to make some money out of it, and you could have lent it to other institutions from your reserve account to their reserve account, and as such. So we said that the Federal Reserve now actually pays reserve balances, interest on reserve balances, and that was actually 5.4% right now, and it's impressively high. And the idea is that I think through these interest payments on these reserve balances, it takes the desperation away from banks to utilize and lend the lost time that they have, and therefore perhaps take a little bit more risk than they're supposed to. And I think that through these interests on reserves, it allows banks to be a little bit more liquid and perhaps consider this as a possibility of lending money um, for what they would consider to be their buffer. And so then we talked about the reverse repo transactions with the facility, where the Fed actually can buy the treasuries from deposit institutions and leave money in the account for overnight or I think after COVID they extended to up to 90 days. And the reason that the banks and the Fed actually do this as a repo is, or the repurchase agreement is to eliminate any price speculations and eliminate the exposure the banks can be to changes in yields of treasuries and therefore the changes in prices. So, imagine this, you actually have a portfolio of treasuries and as a bank, and when you have a cash need, you actually sell some and use it to satisfy that need. But the problem now is that the next day you actually have money coming in. Now you want to buy back that treasury, put your buffer, your security portfolio back, but the price of that bond can actually change. And especially in the last year, when the Fed has been changing the interest rates so much, the volatility in the treasury market pricing is incredible. I've never seen anything like this, and that would actually cost banks a significant exposure and significant risk, and that would be very pricey. So by doing a repurchase agreement, the Fed is actually buying the securities from these banks and then promising to sell them back at a specific price. And therefore, the banks actually are never exposed to excessive amount of price volatility in the treasury market. So that's why the repo or the repurchase agreement facility is quite useful. And that's why it allows the banks to fund themselves overnight without taking treasury risk, price risk, market risk, interest rate risk. And from a Federal Reserve perspective, when they lend the money, they basically are fully collateralized because they're buying treasuries. And if there are any overnight defaults, well, the Fed is actually fully collateralized with the treasuries, and therefore, from a Fed perspective, they're not taking any individual bank credit risk, default risk. Then we talked about how there are term deposits, how the Fed now allows banks to have term deposit accounts from their reserve. So if they have any, now that the reserve requirement is zero, anything they have in the reserve account is actually excess reserve. So anything that they have in the excess reserve, they can move it into a term deposit facility, and therefore that will allow them to earn a little bit more interest, and it will allow them to have access to their reserve, excess reserve amounts. Then we talked about the central bank liquidity swaps, and these were extended to several more banks internationally during the COVID times. And the idea is very simple. Right, so this is, these are the banks. So the idea is actually very simple. You want to make sure that individual banks, the central banks, have access to US dollar liquidity and vice versa. So, for instance, with Bank of Canada, you want Bank of Canada to have access to liquidity in US dollars, and you want to have some Canadian dollars in your liquidity arsenal. And so, if there are any issues in Canada with respect to the US dollar liquidity, as Fed, by having this swap of Canadian dollars for US dollars with the central, the Bank of Canada, you are allowing the Bank of Canada to remedy the liquidity squeeze, if you will, in their economy in US dollars, and therefore you are preemptively preventing the US dollar liquidity spillover from Canada to US. So while it looks like we're helping them, it's actually in a way we're helping them so that we don't get contaminated by that liquidity squeeze. And the swap literally means that we give them US dollars, they give us their currency with the exchange rate, but we know the exchange rate to swap it back. So there is no currency risk for either side. We fix an exchange rate today, and it will be good until the maturity of the liquidity swap. And it is actually a very it's a reliable system in that they don't supposed to have so much money in it right now, but at times when needed, they can actually fund this facility significantly so that there would not be any significant spikes in US dollar liquidity demand that would contaminate the markets. So then now we're actually talking about the Foreign and International Monetary Authority's repo facility. So the idea behind this and the central bank liquidity swaps are pretty similar, actually. So if you think about it, we want to provide these central banks and international monetary authorities with US dollars. And we want to do swaps, which is great. But there are other international monetary authorities other than the 5 or 6 that we just talked about. And like I said, during the COVID, Fed actually extended the list of banks who are allowed to do these swaps to significant many. However, during any sort of period where the US dollar liquidity may be needed, these swap arrangements may not be as fast. And therefore, what Fed does is it actually allows these central banks and international monetary authorities to open an account with Fed and keep U.S. Treasuries, and this is very, very common. The central banks around the world actually keep U.S. dollar reserves as part of their. We talked about how the central banks intervene into their own currency markets and how they operate internationally for the international trade and for their wire transfers, their monetary market payments and borrowing and as such. I mean, if you think about it, every country has to operate in US dollars. They have to borrow in US dollars. They have trade that they have to pay in US dollars, like agriculture, trade, energy that they have to pay in US dollars. So every country, through their central bank, will have US dollar reserves. And you also have private commercial banks to have US dollar reserves as well. Through their correspondent banks, they have accounts, and in these accounts, they have US dollars. The banks that I worked at, for instance, in Turkey, we used to have accounts in Bank of New York or Chase or other banks in the US, and we used to have US dollars in cash in those accounts. So, very much like a checking account, if you will, the banks will have these accounts. So from a central bank perspective, they also keep some of this money in terms of US treasuries. It will earn some interest and it will be liquid. And as long as they're short term, they really have no risk. And at one time, China, for instance, had a little over $3 trillion in US treasuries. And so it's very common for international central banks to keep US treasuries in the US. So Fed allows these central banks and other international monetary authorities to open accounts with the Fed and keep cash and US treasuries with it. So through the FIMA, or Foreign and International Monetary Authority repo facility, Fed can do a repo or a repurchase arrangement with these central banks. If they need liquidity, Fed will buy these treasuries from these central banks and then promise to sell it back. So very similar to the repo arrangements that Fed has with the domestic banks through the Federal Reserve banks, the Federal Reserve now has these arrangements with the foreign central banks and other international monetary authorities. and that if there's a need for US dollar liquidity in these countries, in these markets, Fed will allow these central banks to do a repo with the Fed and receive that liquidity without taking any yield or interest rate risk or the market risk with their treasuries. So, yeah, so this facility provides at a backstop rate an alternative temporary source of US dollars to a foreign official holder of US treasuries. So, and it also, I mean, if you think about this, by the way, um, it also has a secondary effect, very similar to the deposit institution's repo needs. The FEMA repo facility also serves a secondary purpose. When the deposit institutions want to sell these treasuries, their sale will be such large amounts. You're talking about billions of dollars. Very similarly with central banks, when they actually want to have large trades because they need short-term funding in US dollars, this will create a sale pressure in the treasury market and could potentially lower the prices of treasuries and perhaps bring in volatility into the treasury pricing market. And through providing this repo facility, the secondary effect would be to eliminate any sort of pressure in the treasury market. So the idea is to help these economies or these central banks, foreign central banks, to have access to US dollar liquidity, but also through the service, eliminate any excessive amount of temporary fluctuations in the US Treasury market, creating demand and dumping, if you will. But ultimately, the idea is so that the international liquidity issues in US dollar would not spill over to the US and create an imbalance in the market and create trouble for us. So, standing overnight repurchase agreement. Right. So this is very similar to the two repo facilities that we talked about. So, when we talked about the liquidity swaps, the overnight reverse repo and then the FEMA, now the standing overnight repurchase agreement facility basically extends these repos to other counterparties. Remember, originally, the idea was extended to deposit institutions through the Federal Reserve banks in their region, and then to other international central banks and monetary authorities. And now we are extending it through the standing repurchase agreement repo facility to eligible counterparty. And it literally is the same facility that we have for banks and the central banks now extended to other counterparties that may not be as a specific, they may not have the size to be a central bank or to be a commercial bank to have significant standing with their regional Fed bank. So now I want to talk about the expired policy tools, and this is really interesting because I think that some of these actually were like trial runs, if you will, during some of them were during the COVID period, but some of them are actually in 2008 and 2009 and so on and so forth. And they've now ceased to exist. However, some of them were really revolutionary, and we've never actually seen a central bank, for instance, to do a commercial paper funding facility, right? Let's talk about these a little bit, and then I'll talk about this a little bit more on Friday, and then we'll continue with comparison of the Fed policy tools with the ECB and the other major central banks. So, commercial paper funding facility was established in March 17 in 2020, and it actually ended 1 year after. And so it's a COVID time facility. So if you think about commercial paper, we're talking about bonds and notes and bills, and they actually are used to finance economic activities, buy credit, and so on and so forth. So, what Fed now is doing is they're actually buying these commercial paper directly from issuers, and so again, it's very uncommon, and I don't remember if any time any central bank to date, by the way, have ever been active buyer in commercial paper market. And the idea, especially after COVID, was to avoid going into a negative interest um, economy, very much like the quantitative easing after 2008 crisis. Um, the Fed chose to fund the market because interest rates were at zero and inflation was thought to be transitory, and the market was paused. Economy was in a standstill because everybody was hunkered down. Production was at its lowest, and we literally expected the economy to go into a recession, and a severe recession, that is. So, based on that expectation, the idea was to provide liquidity to the market. And as we talked, as there are more paper issued in the economy, the paper is issued and money is drained out of the economy. So what Fed was doing with this facility was to literally buy commercial paper in the market through an active interventionist policy and get the paper into their own balance sheet and then fund the market with liquidity. So and as the Fed continued doing this, it actually created significant liquidity in the market, which I think that helped the market to recover after COVID, and and you know now blamed for inflationary effect of such policy, right? So this is not a repo, by the way. Like this is literally uh, Fed buying commercial paper directly to their balance sheet. Very similar to the quantitative easing. The main difference is with the quantitative easing one, two, and three, Fed was buying US Treasuries and draining the market out of the US Treasuries and leaving cash in the market. This time, they're actually buying commercial paper. They're not treasuries. They're actually issued by sometimes, well, a lot of the times, um, non-banks. So we're not even talking about treasuries. We're not even talking about bonds by banks, but by commercial entities. So it's very interesting. Um, so we have, so I'm going to go through all of this, but some of them are actually a little bit more related. So I want to go through those related ones first. Um, and then right there, right? So the municipal liquidity facility is also established in 2020, and it actually is intended to help provide liquidity for municipalities in the US. So the facility was very similar to the corporate bond buying, um, or what was it called? Commercial paper funding facility. This was actually designed to purchase up to $500 billion of short-term notes directly from the US states, US counties with a population of at least 500,000 and city populations of blah, blah. So the idea is very similar to trying to help commercial entities, non-bank entities, and the businesses by buying their bonds in the market and leaving cash to the market. But remember, it also creates demand these bonds, and therefore, excuse me, it creates demand these bonds, and therefore, it increases the price and lowers the yield. So it also decreases the cost of borrowing for entities. And I think just as it creates a liquidity, the secondary impact of lowering prices through creating demand, I mean, lowering yields, through creating demand for these commercial papers, Fed achieved a lower borrowing cost for commercial entities. With the municipal liquidity facility, they're doing exactly that, but for municipalities and the states and the cities. And the idea is to provide funding at a reasonable cost and to create liquidity in the market, create government lending in a way. Um, so, there's a huge discussion, obviously, with the macroeconomics where the government spending is one of the foundations of economic activity, and it actually can be used to stimulate economic activity. But in lack of government spending, this is government lending. So as providing funding for corporations or commercial entities and municipalities, the Fed is trying to fund the market with low cost money, and this is an alternative to creating negative interest rates in the economy. So with the primary market corporate credit facility, again after COVID, um, right. So, and it actually ceased to exist. And this is again, right. So rather than buying commercial paper, Fed now is directly providing a credit facility for investment grade companies, as well as certain companies that were investment grade as of that date. So again, the idea is to provide funding for the market, allow companies to have access to low interest and circumventing some of the financial institutions. So, and maybe a side note, in 2008 and then up until 2000 and I want to say 16, 17, Fed was going through the quantitative easing, and the idea with the quantitative easing was that Fed was funding the financial institutions, deposit institutions, and in the hopes that these institutions would be funding the economy. So, the Fed's thought was, let's give cheap money, free money to banks, and then banks will in turn lend this money to retail, and then to corporations, municipalities, businesses, and as such. And then these entities will have access to money, low cost money, and that will create business activity and that will create economic activity. And therefore, we won't go into recession, or we will come out of recession and we'll have a healthy GDP growth. But it turned out that many of the financial institutions not only did not do this, either out of conservative or they simply just funded international, or they choose to fund larger corporations, taking less risk. So the intended result was limited. So through these policy tools, now that expired, like commercial paper, primary market or the secondary market, and then the municipal liquidity, and I guess the Main Street lending program as well. So the idea is the Fed now is circumventing the commercial banks and lending to these, sectors directly, or these borrowers directly, so that it's actually having that immediate effect in the economy itself. And I think that this is quite unorthodox in the sense that I don't think that any central bank has ever done this, at least not that I know. So it's actually very exciting. It did work so much that now we have too fast growing economy. Well, not growing, too fast monetary supply, and therefore we now have inflation. So it worked really well. It worked too well. So the secondary market corporate credit facility is basically by purchasing the secondary market corporate bonds issued by blah blah. So this is not to maybe I shouldn't say blah blah. I mean, you can read it, but I feel like I don't supposed to read that out to you because you can actually read it then, right? But anyway, so purchasing in the secondary market corporate bonds issued by investment grade US companies or certain US companies that were investment grade as of March 22, 2020. So, and as well as the US listed exchange traded fund, right? So again, this would not be buying the corporate bonds directly, but this is buying in the secondary market and and removing these bonds from circulation in a way. And this wouldn't be funding the individual corporations or businesses. However, this would be funding the entire market, increasing the price of these bonds and therefore lowering the yields of these bonds. And as the yields are lowered through this activity, corporations will be able to borrow more at this lower yield. And so this wouldn't provide directly funding to the third parties, but this would be a way to lower the interest or the yields even further in the secondary market, right? So it is a secondary market operation. So I think it's time for to call the day for today. And what we'll do on Friday is continue talking about this and finish it. And then we'll talk about how some of the Fed, um, the monetary tools or policy tools are similar or distinct compared to the ECB and some of the larger central banks. So thank you so much. I really appreciate you working with me and hope to see you soon. And if you have any questions, please let me know. Thank you. Bye now.